Good morning. My name is Tim Nyland. I'm Managing Director of Professional Services here at Zacks Investment Research. Today is July 8th, and it is our weekly strategy call for internal team members. Adam Cohen has been working on a project for us for months where he's gone back and taken all of the trades that we've more or less on paper executed via the quarterly rebalance procedure for the earnings certain portfolio. And this is the 75 stock earnings certain portfolio. And he's gone back and utilizing the QZRS system at Zacks, been able to go in and utilize the point-in-time databases and actually reconstruct actual performance for the 75 stock earnings certain portfolio. So what I'm going to do is I'm going to present the portfolio performance relative to the SP 500. We're going to look at the performance. We're going to look at portfolio metrics like turnover, stocks held, stuff like that. And then we'll take a look at some of the risk characteristics as well. And the idea is I want to show everyone how this more or less mirrors all of the return metrics as well as the risk metrics that I have been presenting as composites for the earnings certain portfolio roughly since December of last year. So everything is in sync, and these results are exactly as expected. At the top of the screen, you'll see that there's a note, and we're actually using the point-in-time values back to 12/31 of 12. So to that point, we're actually utilizing the real holdings. So as something like a Praxair or Airgas, something like that were acquired, we actually revalue the portfolio at any cash flow, link the returns, the whole 9 yards for membership changes, for everything. So, and then prior to 12/31/12, those are going to be more or less a static portfolio, but we wanted to give an idea of what those actual returns would look like. So everyone's aware that the earnings certain portfolio is a 75 stock portfolio. Keep in mind, it shows up here the average number of stocks held is 70, and that's because everyone is aware via my webinars that we actually raised the membership of the earnings certain portfolio from 50 members to 75 members sometime 5 or so years ago, and that was obviously because the earnings certain portfolio became so consumer name oriented, heavy, I should say, that we needed to diversify that out just a little bit. So the one thing I want to mention as well, I always speak of the turnover being extremely low. It is. We're talking about a total annual turnover of roughly 8%. But what I want to do is just kind of focus on some of these performance metrics, specifically looking at, the all market annual, the up, the down, the positive, the negative. And you'll see that in all markets, the excess return is basically 3.64% a year. Up markets, we lag a little bit, and I want to bring everyone's attention down to the periods outperforming the S&P 500. So I'm now shifting my focus from this up annual, where we actually lag about 4.99% excess return negative. This is where I stress the importance of applying the tilts, which we're going to look at in much greater detail here in just a few minutes. And it's the application of the tilts themselves that are going to bring this up market annual return significantly higher. And right now, we're looking at the core earnings certain portfolio without tilts. So just keep that in mind. The idea behind the earnings certain portfolio, again, was that defensive measure, and I want to show how well this does in actuality. You can see the down market periods here, 49 of them, and we have an 87.5% outperformance rate. That is absolutely spectacular, where we're outperforming the S&P 500. In all market, without the tilts, our average is a 56.11. That's spectacular. Okay. If you take a look at our positive excess return during positive markets, 16.27, negative 18.4. The idea here is I like to look down at the max drawdown, which is basically 29% versus 51 roughly on the S&P 500. A beta of 0.76. Obviously, the market beta is 1. Standard deviation much lower. Risk-adjusted returns measured by Sharpe ratio much higher. All of these metrics are as expected and as we see in our composite work that we do in the Zacks research system. So again, with composites, the assumption is you have existing membership and you assume that membership historically. And the work that Adam was able to do for us, and I can't thank him enough for doing this over the past several months, actually took the real trades on paper that we did for the portfolio all the way back to 12/31 of 12 and applied those in our point in time databases. So the nice thing is when we get these huge buyouts with premiums like Praxair, Airgas, others that were bought out, those returns actually get compounded into these results. So anyway, we're really happy with this. The idea is we will put these results in a PDF documents that we're working on, hopefully get them into Advisor Tools this month to get a lot more supporting documentation out on the equity model page. And just a reminder that either the end of this week or beginning of next, we will have a production release of Advisor Tools that will feature the new earnings certain dividend aristocrat portfolio. So we're all looking forward to that. So what I'd like to do now is just kind of focus on this upmarket lag on this excess return of negative 4.99. Because obviously the tilts are where we make up for that. And I've stressed the importance of tilts in applying tilts to any core equity portfolio. And so we'll take a look at this. And we're going to use Advisor Tools this week. I love to use the Zacks research system. It's obviously a really hardcore valuation, fundamental analysis type tool. But there's a lot of this that we can do in Advisor Tools as well. And I just wanted to kind of showcase some charts that I created. I think that to the extent we get some positive feedback on this stuff, I would consider these charts something that we would maybe want to add to the Zacks default library, but I'll leave that up to Adam and Jeff Schreck to determine that. So one of the things that we're looking at here is obviously the 6 tilts. So it's going to be the top 5 S&P names in terms of market cap, plus Adobe. And I always stress Adobe. And I think that after you see this analysis, you'll finally realize why Adobe is such a key member of this tilt group. If you haven't heard a lot about Adobe, you soon will. The returns, specifically on invested capital, that Adobe has are just absolutely spectacular. And they really need to be a key part of any portfolio. We utilize them obviously in terms of a tilt, but they can also be considered a core equity position as well. So we've got the S&P 500. What we're looking at here is the tilts plus the S&P 500, and we're looking at this year to date. And you can see that here. So you've got obviously Amazon up 60%. And you've got the rest of these. The idea here is that everybody is more or less not only beating but burying the S&P 500. I think the lowest outperformance is Google, and it's still sitting at roughly a 14.5% outperformance of the S&P 500. So that's your lowest performing tilt. I think you'd call it a good day, specifically year to date. So if we're going to look at valuation metrics, one of the things I want to stress is the importance of knowing where earnings revisions are. And one of the traps that everyone is falling into that I speak to over the past couple of weeks in doing valuation analysis is not understanding where earnings are. Keep in mind that roughly 40% of companies in the S&P 500 have now suspended guidance. And so, we're left, if we want to look at forward PEs, without the companies issuing guidance, yeah, we have sell-side models to guide us, but they have no guidance. So what are we really looking at with 40% of the S&P names when we're doing PE F12M type analysis and even PED growth analysis? We really don't have a whole lot to go on. So it's really important, and what I've got here is I've got basically all 6 tilts, 10-year EPS before non-recurring items. So these are the clean earnings. These aren't GAAP earnings. These are the ones that are actually scrubbed for all the non-recurring one-time events. This is definitely the preferred earnings series that you want to use for any valuation analysis. It's what all the institutional guys are using after they adjust for, like I said, those non-recurring one-time events that are non-operational. So the idea here is you can see that we don't have any earnings troughs, right? So if we're going to do PE analysis and we have an earnings trough, we would see some PE multiple ultimately that would just be largely inflated, not because of necessarily an increase in price, but perhaps an increase in price at the same time your earnings have just absolutely fallen out beneath you because of the COVID shutdown. So the point of this chart here is just to show that we've got solid earnings growth historically. We go into this, this post-December 19th period, and, at best, we have maybe a little bit of a slowdown in earnings. A lot of this related to COVID expenditures. We know that from Amazon and others. But others are obviously just continuing to plow right through this, virtually unscathed, which is the whole idea behind this tech leadership group. So this is a great chart to use, 10-year EPS before non-recurring items chart. So I'll go back into my library. We'll look at the next chart, which is obviously the PE. And what I'm trying to show here is how expensive some of these names are. And the reason this is important is because these are recommended tilts. And, I'm not one for paying a lot for stocks. I like to get stock. Everybody likes to get a bargain. But you've got to remember in this type of a market, the money is chasing where the growth is at. And the idea is to be able to kind of quantify, exactly what this looks like. So in order to do that, I went over here down on the left and I actually set up a compare to global sectors. So this is where we roll in our composite capabilities into the Advisor Tools system. And I just said, show me the absolute, which is basically a line. I didn't make it relative. I just said, just make it a separate line. So you can see that more or less that straighter line down here, that's going to be your composite. And the idea is not to look at the absolute value itself, but just to say, okay, well, everything appears to be expensive because everything is appearing higher than that relative line. The only thing that's really less expensive is Apple, and Apple traditionally trades at a discount, although Apple is getting more expensive in terms of a PE, and that's obviously related to the ecosystem that Apple has built out, which has been coined by many as being quote unquote bulletproof. And when you have that sort of a scenario playing out, not only does it lead to earnings stability, that consumption model day in and day out with the App Store, among other things, has really been able to provide support for Apple's PE. Apple used to trade at a PE of 10 to 12. Now we're seeing it on a forward 12-month basis of roughly 25. But you can see here, obviously, Amazon, continues to reach for the stars. I was never a believer in Amazon. I never believed in the valuation of Amazon. But after, so many years, I finally caved into the fact that this thing is just going to continue to trade at this multiple, and that's just the way it is, obviously, until it doesn't. One of the rising stars, you'll see that Adobe continues to trade at this premium. These guys are the ones who obviously pioneered the subscription model to enterprise software. They continue to be rewarded. I continue to say nothing happens on the internet without these guys. Few people even know what they do. They use their software every day. it's Illustrator, it's PDF, and they do a whole lot more than that. They're becoming a huge, huge cloud player, and we'll see why they're so important here in just a minute. So looking at absolute PEs is great. We can see that they're expensive, but let's take a look at these relative to growth to try to find some justification. And so what we're going to do is literally take the PE F12M that we just looked at and divide it by the 5-year growth rate estimate median coming in from the sell side. I should say the 5-year estimate mean, not median, coming in from the sell side analysts. So that would be this chart here, and I literally just grabbed out of the financial metrics. It's going to be the PE F12M PEG ratio. And so now we're just literally dividing the PE by that 3 to 5 year forecasted growth rate, what we call a long-term growth rate, and plotting this out. And we're just looking at a 2-year chart. And at this point, you can see that Amazon is still expensive, but just back here in March, they actually were right on target with Adobe. And they weren't that much more than the broader market. But you can see how the e-commerce numbers and everything else have reported just absolutely blown the expectations off the street, and Amazon stock has just absolutely gone parabolic, and you can see that. The interesting thing to note again is where the information technology sector lies. So again, I have this compared to the global sector here, which is key, and you can see that. In the charting facility and advisor tools, we're doing this in real time. So, you can see that as I'm going through and I've saved all these reports off, I can just quickly go back and activate any of these metrics I had. I've actually saved individual ones just so I can flip through. But in terms of PE to growth, you can see how cheap Facebook is. You can see how cheap Google is, but they've always been that cheap, right? So this is just more the advertising nature of that business. These enterprise type solutions, and Amazon kind of speaks for itself. They always traded a little bit higher premium. So what I want to do now is try to kind of find further justification for this type of valuation. And this is a trend that I just want everybody to make note of. You really need to look at the return on invested capital. So, what are they able to return in excess of their, weighted average cost of capital? And when you look at this metric, and this is something that, I was almost hesitant to show today, but I spoke with Adam, and it looks like it's kind of a null value. We've got on the invested capital portion of the ratio. We've got to talk to the database team about lightening up the constraints and being able to show this line. Adam's going to take care of that for us, so hopefully within the next couple of days we'll get this series drawn out. My expectation is it's just going to be more of the same. The return on invested capital for the average in the S&P, I should say the S&P global sector for information technology is still going to be among the lowest. Right alongside of actually Amazon, believe it or not. I want you to see the rising star, and you'll see why I now have recommended and will continue to recommend Adobe as a core tilt or part of any core portfolio. They're actually leading the pack on return on invested capital, even higher than Apple, if you can imagine that. Facebook doing really well. Obviously, Facebook, Google, and that business are very, very profitable businesses. So, this return on invested capital is really, really where you want to go to try to find your justification or to otherwise challenge some of the PE ratios, PE to growth, and other sort of valuation metrics that you're seeing and reading about. So, I wouldn't panic about the valuations of these leadership stocks because they are delivering on their return on invested capital. And my expectation is that they will continue to deliver. This is where the growth is. And investors are going to continue to pay up for this growth. At some point in the future, will that appreciation, begin to taper and wane as as value and emerging markets and some of these other, sectors that have been just absolutely hammered, like financials, begin to recover, certainly that'll be the case. But as far as that happening anytime soon, I just don't see that in this environment. Given where we're at with COVID, vaccines, even therapeutics, there's just too many unknowns, and these guys just continue to be the leadership group. So that's just a really, really quick, orientation about how you could utilize advisor tools just to do some of this really quick and dirty valuation work. It's very powerful, and I do suggest that if you go into the financial metrics themselves, we've got just an enormous library of all sorts of great fundamental valuation ratios, returns, everything that you can utilize. So anyway, if there are no questions, I'll go ahead and wrap up today's strategy session. Anybody have any questions? No? All right. Thank you, and we'll talk to you next week.